Hi there. In this video, we walk through how UK traders can calculate crypto gains step by step, following HMRC rules.
Hello and welcome. Today, with a little help from our friends at My Tax Accountant, we are going to get into a topic that is, well, it's absolutely critical for anyone holding crypto in the UK. We're talking about how to calculate your crypto gains for the taxman in 2026. Look, whether you're a serious trader or you just have a few bits and pieces, the whole game is changing and you really need to be ready for it.
So let me just ask you straight up, have you made any profit on your crypto this year? You know, maybe you sold a bit of Bitcoin to pay for a holiday, or maybe you swapped some Ethereum for a promising new altcoin. If the answer is yes, even to a tiny transaction, you need to listen very, very closely, because the way HMRC looks at those transactions is about to change forever.
And here's why. From the very first day of 2026, the rulebook got thrown out. The days of your crypto activity being kind of under the radar, they are officially over. Done. Crypto platforms in the UK are now legally required to automatically report all of your trading data directly to HMRC. There is, quite literally, nowhere left to hide.
So, you might be asking, why this massive change? Why now? Well, this number says it all. HMRC reckons these new rules will bring in an extra £315 million in tax by 2030. That is a huge incentive for them to track every single gain. So trust me when I say, they're taking this very, very seriously.
Now, I know that sounds a bit intimidating, but don't you worry. We're going to break it all down for you step by step. We'll look at HMRC's new rules, figure out what actually counts as a taxable event, then get into how to calculate your gains. After that, we'll cover allowances and tax rates, how to report everything, and finally, what your next steps should be. So, let's get into it.
Right. First up, let's talk about these new rules for 2026. This is what we're calling the end of ambiguity.
Okay, so this big change is all down to something called CARF. That stands for the Crypto Asset Reporting Framework. And you need to know, this isn't just a UK thing. Oh no. This is a new global standard that's being rolled out to bring crypto tax in line with, traditional finance. The UK is just one of more than 50 countries signing up, creating this massive worldwide network for sharing tax info.
And just look at the level of detail the exchanges have to hand over. It's everything. It's not just your profits. They're sending HMRC your full name, your address, your national insurance number, and a complete summary of every single transaction. I'm talking buys, sells, swaps, the lot, along with its exact value in pounds at the time it happened.
And here's a professional tip I really want to hammer home. This isn't just for the big-time traders. These rules apply to every single UK taxpayer who uses crypto, no matter how small the amount is. Whether you made one little trade or 1,000, that data is now going straight to HMRC. Total transparency is the new normal.
So we know they're watching, but what exactly are they looking for? Let's dive into what a taxable event actually is, because, and this is important, not every single thing you do with your crypto will trigger a tax bill.
The key word you need to get your head round is disposal. And a disposal is much broader than just selling for pounds. You can see here, if you swap your Bitcoin for some Ethereum, that's a disposal, that's a taxable event. If you use your crypto to buy a coffee, yep, that's a disposal too. But just buying crypto with pounds, holding onto it, or moving it between your own personal wallets, those things do not trigger a tax event.
Okay, time for the main event. How do you actually calculate your gains? Now, the basic formula is pretty simple. It's just what you got for it minus what it cost you. But, and this is a big but, the way HMRC forces you to work out those costs is very, very specific. See, you can't just pick and choose which purchase you want to match against a sale to get the best result. Nope. You have to apply these 3 matching rules in this exact order, no exceptions. First, you have to use the same day rule, then the 30-day rule. And only after you've checked for those, for everything else that's left, do you use the Section 104 pool.
And for most people, this third rule, the Section 104 pool, is the one you'll use most often. The easiest way to think about it is like this. All of your holdings of one particular crypto, let's say Bitcoin, are all in one big imaginary pot. Every time you buy more Bitcoin, you add it to the pot, and you work out a new average cost for everything in there. Then when you sell, you have to use that average cost to calculate your gain.
Let's walk through a quick example. This is Aisha, a freelancer.
She first buys 0.4 ETH for 800 pounds. A bit later, she buys another 0.6 ETH for 1,500 pounds. So her Section 104 pool now holds a total of 1.0 ETH, and the total cost in the pool is 2,300 pounds. Simple, right? Now, sometime later, she sells half an ETH for 1,600 pounds. To work out her gain, she has to use the average cost from her pool. The cost of the 0.5 ETH she sold is half of the total pool cost, so that's 1,150 pounds. Her taxable gain is simply the sale price, 1,600, minus that cost of 1,150, which gives her a gain of 450 pounds.
Now, some good news. You can actually reduce your taxable gain by deducting certain costs. We call these allowable costs. This includes things like the transaction fees you pay to an exchange when you buy or sell, and any network or gas fees that are directly related to a sale. But be careful here. Gas fees that you pay just to move crypto between your own wallets are not deductible.
So, you've calculated your gain. Fantastic. The next question is, how much tax will you actually end up paying? Let's look at the allowances, tax rates, and importantly, what to do with any losses.
Right, every single person in the UK gets a capital gains tax annual exempt amount. For the 2026-27 tax year, that amount is £3,000. What that means is the first £3,000 of your total capital gains for the year, and that's from all assets, not just crypto, is completely tax-free. But, and this is a word of warning, you can't carry this allowance forward. It's a use it or lose it deal each year.
Now, any gains you have that go above that £3,000 allowance will be taxed. The rate you'll pay depends entirely on your total income for the year. Essentially, your capital gain gets added on top of your salary or other income. If that total amount still keeps you within the basic rate income tax band, you'll pay 18% tax on your gain. But if it pushes you up into the higher or additional rate bands, you'll pay 24%.
And here is a very, very important tax-saving tip. What if you made a capital loss on some of your crypto? You sold for less than it cost you. Well, you can use those losses to reduce your gains. You have to offset them against gains you made in the same tax year first. But if your losses are bigger than your gains, you can report them to HMRC and carry the extra forward to slash your tax bills in the future.
Okay, you've done all the calculations, you know your number. Now for the really critical part, reporting everything to HMRC correctly and, of course, on time. Let's look at the key dates for the 2025-26 tax year. The tax year itself ends on April 5th, 2026. Now, if you've never filed a tax return before, you have to register for self-assessment by October 5th, 2026. The big one, the final deadline to file your return online and pay any tax you owe, is January 31st, 2027. Get these dates in your calendar, because if you miss them, you're looking at automatic penalties.
So, with HMRC now getting all this data automatically from the exchanges, your personal record keeping has to be absolutely perfect. They are going to use their data to cross-check what you put on your tax return, and you can bet any differences will be flagged immediately. You must keep a detailed log of everything: the crypto you used, the date, the number of units, the value in pounds at that exact moment, everything. And you need to hold on to these records for at least 5 years.
Phew. Okay, we have covered a huge amount of ground today. So, let's bring it all together. What are your next steps to go from, well, a bit of confusion to full compliance?
Look, the reality of this new 2026 tax world is that trying to do your crypto tax yourself is, well, it's riskier than it has ever been. The rules are complicated, the record keeping is intense, and HMRC's watchful eye is now guaranteed. As crypto becomes a normal part of the financial system, the question really isn't if you'll pay tax, but how you'll manage all this complexity. For professional, stress-free help, you can contact the team at My Tax Accountant on 0208-570-8531. Or you can email them at info@mytaxaccountant.co.uk. And for more updates like this, make sure you subscribe to their YouTube channel. And just a quick final note, please remember this video is for your information only. It is not financial or tax advice. You should always consult with a qualified professional for advice that's tailored to your own personal situation.